All right, here we are. First webinar of the year for the Florida Photonics cluster. Today, we're going to be talking about business tax saving strategies presented by CLA. I want to thank our sponsors, our platinum sponsors, Orange County Government, the Corridor, OptiGrate, Imperks, gold sponsor, ER Precision Optical, silver sponsors, Enterprise Florida and Orlando Economic Partnership, and our bronze sponsors, Sphericon and the UCF Innovation Districts. So these sponsors are annual sponsorships that are providing a financial commitment to help see the cluster grow and improve opportunities and the spotlight on photonics in Florida. So we thank them very much for that. So as I mentioned, today we're joined by CLA, Marty Spence, and our team with Jenny, Tom, and Sylvia. So I'm going to turn it over to, I believe Sylvia is going to present now, and Marnie, I think I'll let you take it away.
Okay, thank you so much, Baron, and welcome everyone. We certainly appreciate this time together. My name is Marnie Spence, and I am a principal with CLA. Sylvia, if you wanted to pull up those slides, but maybe what we should do, well, there's not too many of us. Sylvia, let's go back and let's have everybody introduce themselves first. I'm so sorry. So Sylvia, you want to introduce yourself?
Sure. My name is Sylvia Whelan. I'm located here in our Orlando office in Florida. I have been with the firm for 15 years. I sit with our manufacturing distribution group. I work mainly with foreign companies and individuals coming to do business here in the US or going overseas and operating overseas. Okay.
Tom?
Yes, my name is Tom Sanamaggio. I'm a signing director in our state and local tax group here in Tampa. I concentrate mainly on indirect state taxes. I guess that's Ginny.
Okay, hey. So Ginny Veet, I'm a principal in the Tampa office. My concentration is in the Federal Tax Strategies Group, so I lead that team for the Sun Belt region, and we do the research and development tax credit work, as well as cost segregation studies and some other tax savings opportunities. So I get to do the fun part where I say, here's how much we saved you.
Yeah, it is always nice when you have Ginny on one of your engagements. So I do like that part of it. Thanks, Ginny. So we just have a few participants. So maybe you guys can go around and introduce yourselves as well and tell us a little bit about your business so we understand your audience, our audience.
We'll start with Lexi real quick first.
Okay, sure. Yes, I'm Alexei Glebov. I'm president and general manager of OptiGrate Corporation. Since 2017, we're part of IPG Photonics. It's a 10 billion NASDAQ traded company. So we're located here in Nevada, Florida, so a couple of miles away from UCF. Manufacturers of optical components for lasers and lasers. So essentially high-tech manufacturer, spin-off from UCF 20 years ago. So I used to learn a lot of, taxation issues and R&E tax and whatever belongs to it probably, 7-8 years ago when some smart people like you, let me discover that we can save on it quite a bit. And it was actually quite useful because besides saving in the future, I mean, you can retrofit it for 3 years, and that was very helpful.
Yeah, yes, that's very true.
Hey, Mike, you mind introducing yourself? You're on mute.
Sure. My name's Mike Machado. I'm the owner and lead wealth advisor at Simple Wealth Management. And most of my clients, a little over half of my clients, are either veterans, defense industry, participants of some kind, business owners, or executives at some of the corporations that are around the University of Central Florida. I'm a former Marine. That's where the name comes from, Simple Wealth Management. And so I focus on providing financial planning and investment advice to veterans, business owners, and just executives in the local area.
Great, thanks. Stefan, are you nearby to introduce yourself?
Yeah, yes, no, I'm here. I just I'm actually not in the office today, so I didn't want to share my video. Yeah, Steffen Schneider here, president of Esfericon Incorporation. We are a company that, well, let's put it this way. Here in Florida, we're a small company that is related to a company headquartered in Germany. In general, our company produces optical elements for, may it be lenses, may it be mirrors, for almost any optical application that's out there, may it be a telescope, a microscope, laser welding and cutting. I mean, just to name a few, I mean, everything that has light basically needs a lens in a way. That's how we always look at it. And so with the broad portfolio we have, or broad customer base also, we have a very successful business, I can say. Here for the US, we're doing business up to the 3 million a year, mostly 2.6 to 3 million a year. In general, the company itself, like including headquarters, we're doing 22 plus million per year. So mainly our job here in Florida as of right now is to support customers with our technical expertise as far as we can, and then obviously sales support. And the whole goal is to have hopefully also in Florida in the near future a production facility, maybe most likely not as big as headquarters is, but to be more in closer to customers and also have more chances to really work with and provide good services to military-based applications, basically everything that's ITAR related. That's something we're doing right now as well, but it's obviously with a facility in the United States, being directly next to the customer. That's our main goal for that as well. Yeah. And one thing also, the whole company is existing for 20 years, so to speak, headquarters, while it's in the 21st year. We are in Florida for 8 years now.
Okay.
Right. And then I'll just finish up with myself in case anybody, especially watching, doesn't know who I am yet. So Baron Mills, been in the role of executive director for the Florida Photonics cluster for about 2 months now. And what's key with all this too is I've got a second role that's connected. I'm the director of the industrial affiliates program for CREO, which is the College of Optics and Photonics at UCF. So essentially, with both roles, I'm primarily doing business development for the optics and photonics industry of Florida, trying to make sure that we're bringing more of a spotlight on the great things that are happening with our companies that are in Florida, growing opportunities for them, and also trying to bring more those kind of companies here to our state, because we think we got the best opportunity to do business right here in Florida.
Mm-hmm. So thank you again so much. I will say, just seeing your sponsorship in ER Optics is that I've been out to their facility quite a bit, and so seen what, understand what they do. And I did sit for a while in the National Center, or the UCF Research and Foundation commercialization board, and so really understood just some of the cool things are coming out of research at UCF just on that optics piece. And so, because understood on that business flow, then Lexi, like how that, the technology was maybe birthed within UCF, but then how it got to that commercialization piece and the success of that. Some cool stories there. So yours being one of them. So congratulations. So let's talk a little bit about, so Sylvia, now let's go back to those slides, is that Sylvia and I are both UCF grads there. And so, so a little bit about CLA here is that if you go down to slide 3, Sylvia, is that why we are all talking from the tax department here is that CLA really has a professional services firm, and really our culture is that we are existing to create opportunities not just for our clients, but also for our people and also for our communities. And so in doing that, just even a presentation like this to bring awareness out to the community of what they should be thinking about, or tax savings and things like that, is always on point to go ahead and do that. The next slide, Sylvia talks a little bit about our firm, is that we are a national firm and that we are throughout the continental United States, but our focus then is owners of privately held businesses. And next slide, Sylvia. So how that sits then is that our focus is industry based. And so I'm giving you here some of our industries that we have out there. Baron, we even do not-for-profit specialization too, is that there, but all of us on this call today sit within the manufacturing and distribution space. And so that next slide really shows that we find an industry, and then these are the different services that we can bring to that industry owner. And so that owner can have revenues of less than $1 million all the way up to 100 million. Those owners, just as yourself, Stephen, and even Alexi, is that you might not be, the true owner of the company, or maybe a partial owner of it, but there's still some services that might benefit you outside of just maybe a traditional owner of, like Mike is, of his company itself. Next slide shows all the people within the state of Florida that have raised your hand to say, we want to get more understanding within manufacturing and distribution. And so that really then, we call it M&D, but manufacturing and distribution then is people that, why we get technical training maybe in, assurance work of audit or review, or tax specialty classes that we will have, and continuing education in that way. But we also have education just in industry as well, so that we are constantly understanding, the industry, and can sit alongside with that business owner and bring value to them outside of just what maybe a tax return might be, or something like that. Today, we're going to talk on state and local tax, international tax, some tax specialty, research and development tax credits, and then I'll finish up with just what we're seeing as we're preparing returns for 2021 right now. But along the way, if anybody has any questions, just please interrupt us and ask those questions. We're more than happy to do that. So without further ado, I'm going to ask Tom then to talk a little bit about state and local tax.
Sure, thank you. And this is really going to be a very high-level general discussion of state and local tax. I know this is under the premise of tax savings, and there's a portion of that is a tax savings discussion. But there's also, as Marnie alluded to before, right? We want to make sure that we advise our clients, and we're advising you as to issues with regards to the states, right? Because historically, people have only operated, in their local area, their local states. And when I say historically, it's many, many years. But obviously, as technology is expanding, businesses are expanding, they're touching more than just their home state. So with that, I just kind of want to give you, so the terminology in state tax is nexus. And what that really means is the state's ability to impose their tax regime on you. Today, we're just going to be concentrating on the general ones. They're income tax, gross receipts, and sales tax. But essentially, it means, hey, I'm a Florida company. What can Georgia do to me? What sort of taxing powers does Georgia have on me, or other states that are not my home state have on me? And so, generally what companies, how they maintain nexus in states outside of their home state is really kind of two factors. And the second one's fairly new, but it's a physical presence and it's an economic presence. And oftentimes when we're talking to our clients, they don't realize that physical presence means a transitory presence, and is also a presence of third parties, like subcontractors acting on your behalf, employees traveling into the state for business purposes. So now all of a sudden it's like, well, wait a second. I thought I just had to pay Florida tax. Now you're telling me there's Alabama, Georgia, New York, California, whatever that may be, based on the fact that I had some subcontractors out there for a couple of days, or my employees were there visiting clients for a couple of days. So the test is really, are they there to establish and maintain a market? So that's kind of your physical presence. Again, very general terms here. And then economic presence is something that's taken place about 3 or 4 years ago, Supreme Court decision of Wayfair. And it's more of a sales tax concern than it is an income tax, but there are states that have this economic presence for an income tax concern. And it's really, hey, you don't even need that physical presence anymore. You just need to sell enough into my state for me to impose my sales tax regime on you. And why that matters is because usually sales tax is not a tax that is borne by the company, they're acting as an agent for the state to collect it and remit it from their customers. But if the state audits them prior to their customers, they're on the hook for the tax. So, to that point, sales tax implications related to sales in the state. Florida, I believe it was last year, passed their economic nexus provisions. It's very similar to other states, $100,000 of sales. Some states have a higher threshold, others have 100,000 of sales or 200 transactions. And what you're seeing here, right, two things, maybe from a purchasing aspect and the selling, you may be seeing your vendors that historically have not charged you tax because maybe they didn't have nexus in Florida are now charging you tax because now all of a sudden they've exceeded that economic nexus threshold, as well as concerns that you would have as a business of saying, well, now I'm selling into these states, whereas before it wasn't a concern, it is now because I've exceeded a certain sales threshold. Go ahead, so if you can go to the next one. And then there's these other taxes, non-income based taxes that are at the entity level, they're gross receipts taxes. And what they do is they sort of have a broad tax base, small tax rate, and all of these states that have them have adopted this economic nexus provision, which basically says you don't have to have a physical presence in my state for me to be able to tax you on your gross receipts. So the money saving things, right? So Florida is much like every other state that does afford manufacturers and entities engaged in R&D several exemptions. And then we're going to concentrate today on the sales tax exemptions, right? That maybe some of you are familiar with. Manufacturing equipment, R&D equipment is oftentimes exempt from sales tax in Florida. Repair and maintenance to this equipment is also afforded that exemption. Sometimes what we see our clients miss is the repair and maintenance, as well as utilities that are used in manufacturing are afforded the exemption from sales and use tax. And some of the more straightforward ones, right, are input materials, what you buy to make what you sell, are exempt from sales tax in Florida. So this was a very, very high level discussion of state taxes. So
Thanks, Tom. I think I wanted to jump in here. Is that the
Yes,
biggest
please.
thing is that that's sales tax on utilities. So your electric bill on your facility, you can include the sales tax on your monthly electric bill on the production piece of your facility. So if you didn't know about that, you can contact your utility company. And if you have problems getting into them, I kind of know some of the higher ups in those utility companies because I've referred my clients to them to get sales tax either stopped, or you can go back, kind of like you did, Lexi, go back a couple of years and see about getting that refund. So
it's actually a very interesting point. I'm surprised that a lot of people have no idea about this, including myself. I mean, first time we learned about it was about 3 years ago. I'm not talking about R&D tax, but this is sales tax on utilities. So we filled out forms with Duke because we're in the Duke area. And we got back also retrofitted 3 years, I guess.
Yeah,
to your point, Alexia, right? It's as simple as giving your vendor an affidavit and here you go, right? It's not, oftentimes it's not a complex matter, right? It's not an administrative.
Very, very simple. Yeah, no, absolutely.
Yeah.
So we learned about it, when we were looking at the construction of a new building. So we did some research, and when it came back, it was like, well, utility taxes are basically exempt. And I was like, okay, wonderful. So what about what we're paying right now without the new building? So, well, it qualifies.
Yeah.
Wonderful.
Yeah. That's it. We always kind of come in and go, that's going to save, you won't even have to pay our CPA bill because you just saved it in that sales tax. So Baron, you can lead with that to get your membership so that you can tell your members about this and then say, I just saved you this and now you can afford to be a member in our cluster.
A sponsor.
So another thing, if your businesses are looking to go to sale, under due diligence, in the past, due diligence firms, we might be the due diligence on a buy side or sell side, either way, the CPAs, all they ask about is state and local tax. It's all they ask about. They pretty aware that you've prepared proper federal taxes, but then they dig into the state and local taxes. So
Yeah, and every state's different with their sales tax regimes, right? And like I was saying, economic nexus, even though, it's been around for 3.5 years, caught a lot of people by surprise.
yeah. Jenny, thank you, Tom.
No
Jenny.
problem.
Absolutely. Thank you. Next slide, Sylvia. Thanks. So just real quick on research and development tax credits. This is what I plan to cover today, but just general overview of the R&D tax credit, or R&E, if you want to call it, research and experimentation. The credit was implemented back in the 80s, and it is to encourage companies to invest in research and development, to invest in new technologies. So it's an incentive that is provided to companies for that purpose. So we can move to the next. These are just the topics I'm going to cover. And so first topic is qualified research activities. So what is a qualified research activity? This definition is going to be broader than a lot of your typical companies are going to think of it as R&D. A lot of times you're going to think of white lab coats and maybe pharmaceutical research, or something like along those lines. But the definition is very broad. I came out of a defense contracting background, and we actually discovered that we qualified kind of by accident. And we had a bunch of engineers. And I can tell you, when I talk to the engineers, a lot of times they would say, I'm not doing R&D, I'm just doing my job. And it turns out that a lot of that job actually qualifies for R&D based on the IRS definition. So here's the IRS definition. You have to have a permitted purpose, which basically means you're making something, you're creating something, and you plan to sell it to other people. It can be a product, it can be a process, it can be a technique, formula, or software. The activities themselves that we get to claim are technological in nature. So we have to be relying on the principles of hard science, not soft sciences like social science or psychology, but hard science like biology, chemistry, physics, and computer science and software development count in that technological in nature. The last two elements, elimination of technical uncertainty and process of experimentation, really go hand in hand. So we have to be able to show that the activities are undertaken in order to eliminate technical uncertainty, which means we have to show we have technical uncertainty. We didn't know how to. We were trying to figure out how we were going to do this. We might have capability uncertainty, which means we don't even know if it can be done. But we could also just have methodology uncertainty, which is we know if we spend enough time and enough money, and enough effort, we'll be able to make the product do what it wants. That might relate especially to software development. And then process of experimentation, we need to show that there is an iterative process of trial and error, success or failure testing, just go. And I will mention that this process of experimentation can be a simulated experimentation. So using modeling software completely, so something like AutoCAD or BIM, those types of things. Next slide, Sylvia. There we go. A few other things we always want to mention with respect to what qualifies for R&D. The party claiming R&D has to bear economic risk for the costs associated. In my example, the company I used to work for, we were a defense contractor, and we had both fixed price contracts from the government, and we had cost plus contracts from the government. The fixed price contracts from the government, this is where we didn't realize we necessarily had R&D. But it was those fixed price contracts from the government where we actually had the economic risk required, because if we said we were going to do the job for $10 million and it cost us $12 million, we had to spend $12 million and we just had a loss. So that essentially means you have economic risk under a fixed price contract. Under a cost plus or a time and materials contract, even not to exceed contracts, though the risk isn't with the person who's building it necessarily. Now that can flip when you're paying a contractor. If I'm paying a contractor on a fixed price basis, the contractor now has the economic risk and I don't have it as the vendor. So if I'm paying a contractor and I want to include those costs, I need to be paying that contractor on a time and materials basis. Additionally, the taxpayer has to retain rights in the intellectual property that's developed. So that just means that you have the right to use that technology going forward. And then for the US, for the federal R&D credit, the activities that we claim have to take place in the United States. So you can have activities that take place in foreign countries, you just can't include that in your US R&D credit calculation. Next slide, Sylvia. So these are the costs that you can include in your qualified research expenses. You can claim the wages, and this is the wages for people who are directly performing those activities. And it's also the direct supervision and the direct support. So direct support might look like a machinist who's helping to build the prototype. Direct supervision might look like a scrum meeting for software development. So we have a weekly scrum for an hour, and we all get together with the supervisor, and the supervisor gives direction. So lots of different ways that we can claim supervision and support in addition to the direct costs. For wages, you are using box 1 W-2 wages and applying the percentage of time that employees spend on those activities. Materials and supplies, we're going to see this in our manufacturing clients and in clients who are making something tangible. Typically, supplies have to be used in the R&D process, but may not be anything that is depreciable in the taxpayer's hands. So any questions about this so far? Just going to pause real quick. Okay. And then contract research, again, a moment ago, I mentioned about that you are able to claim contractors that are working for you. It just means that the contract has to be structured so that the taxpayer that wants to claim it bears the economic risk. And then leased computing is kind of an interesting one. Leased computing is original to the R&D credit back in the mid to early 80s when they implemented it. And that was back in the old days. I remember my dad was a software engineer back in the 80s, and I would go to work with him, and they would have this giant room that's like almost as big as my office, that would be just this room that was super cold and had this big mainframe computer in it. And you would, companies could lease time in that because you really couldn't afford to purchase the computing power. So this is where that comes from. For a long time, this was pretty much dead. Nobody was taking leased computing. But now that cloud computing has become so prevalent, the rules here are the computer can't be on your premises, you can't be the primary user of the computer, and you pay to use the computer. So leased computing in software development would qualify for R&D credit to the extent that it's used in the development and that the activities taking place are qualified. Next slide, Sylvia.
I am so sorry. We've done a really great job to invite everybody to ask questions, and now they have in the chat, and we're just ignoring them. So
I'm so sorry.
Yeah, and so let's stay with the R&D, and then Tom, we're going to come back if you can go to the chat so you can get your answer to Mike. But so here's the chat that Baron's asking. Are you able to provide any general examples of how much in annual tax savings you see businesses achieving once they are applying these R&D credits?
Yeah, great question, Baron.
And then another question he had is, so for those intellectual property rights, does that still apply to companies with SBIR, STTR contracts where the companies retain the IP for commercial purposes, but usually are giving the government free rights to the IP as well?
Both are excellent questions. So I'll start with the second question first. With related to the IP rights under an SBIR, STTR, yes, that shared rights counts. So it doesn't matter that the government gets rights in the IP. We've actually reviewed the SBIR contracts, and those contracts, as long as they're fixed price, and I've not yet, I'm sure there are some cost plus ones, but I haven't seen them. So yes, you would, for an SBIR contract, you would be able to take that and consider the rights that you have, and that would be qualifying for R&D. Does that answer it, Baron? Any clarification on that?
No, that's great. Yeah, that's what I was.
Okay. Perfect. And then yeah, actually, I was getting to an example of how the credit calculation works. And I would say you can count on, assuming that your spending is at least flat, right? At least a flat spend year over year. You could count on getting at least 5% in credit, but it can go up to as much as, it can go over 10%. So of all those costs that we throw into qualifying, did you have a question, Baron?
Yeah, well, it just popped in my head also. So, 'cause I'm assuming there's plenty of companies that you work with that they find out about this well after they could have been already applying it previous years and stuff.
Yes.
Are you able to go back and retroactively apply these to get past the
You
year's
are.
credits? All right, great.
You are. And so if your company is a C Corp and you've been generating losses, you can go back a really long time. Like, so you can go back as long as the net operating loss has been generated. That's getting a little bit techie. But in general, you can go back 3 prior years. So the statute of limitations for your return is 3 years. That's how far back they can go back to audit you. It's also how far back you can go to amend your returns and claim credits into the future. So I don't necessarily need to go through this whole example, but it's basically showing you that if you spent an average of $1 million in the prior 3 years, and then you spent 1.3 million in the current year, you would end up with a gross credit of 112,000. So the credit is 14% of the amount that you spend over the hurdle, and the hurdle is 50% of the average of what you spent in the past 3 years. This is the alternative method. And so there is a regular method as well. And the regular method, and I don't know the age of the average company in this group, but startup companies can use the regular method as well. And there's 2 methods of calculating the credit. And can you show me the next slide, Sylvia? I don't remember if we did a regular credit. We probably didn't.
Those were the only slides we had.
Those are the only ones. That's fine. So the regular credit can be higher and sometimes in some years, and you can just go back and forth. So you can use the regular credit in 1 year. Then the next year, it turns out the alternative is higher, because as you can see, the way the alternative works is if your spend is trending up, your alternative may be higher. Under the regular method, you're using a percentage that's based on your gross receipts amount. And one other thing I'll mention to this group, just in case there's any startup companies, there is an opportunity to calculate your R&D credit if you are in losses. There's an opportunity in the first 5 years, once you have revenue, to calculate your R&D credit and take it against your payroll taxes, which is a great opportunity for somebody, for startups that are looking for cash flow. Any other questions about R&D?
Yeah, Ginny, one question, Stefan Schneider here. Sorry, without a picture,
Sure.
but I don't know if you were already connected when I introduced this Ferricon a little bit. Basically, we have headquarters in Germany where all the production happens as of right now.
Right.
But we have the office here in Florida, and we do a lot of technical support in the beginning of a product, so to speak, when a customer comes to us. So when would it even be possible? I mean, we're selling the product at the end, right? So is it still a chance for us here in Florida to say, let's say the first 50 hours of the project were dealt with exclusively here in Florida, and it was R&D because it was the technical support until we got to the decision on how the lens in our case will be made and what will be made.
Absolutely. Yeah, absolutely. You could claim, so, any part of the, as long as we meet that 4-part test. So you're making a product, we know that's true. The activities are technological in nature. So we're talking about, engineering and,
Yep.
those kind of sciences. You've got your technical uncertainty and a process of experimentation. So bid and proposal costs, I would kind of almost equate it to that, or point out that you could also take bid and proposal costs. So pre-winning the work, those activities that you might do is, when you're trying to figure out a design, you can absolutely claim those costs. You just couldn't claim any costs for activities that take place, in Germany or anywhere else.
Yeah, obviously. How would somebody go about and basically report this to a CPA? Would we say project this was like 5 hours, the next project was 50 hours, and then it depends on, and then we have to go specific and saying, let's say there's 2 employees, just to one makes 50,000, one makes 70,000. You have to break it down this way as well.
You do.
Just saying.
You
Yeah,
do.
okay.
So what you need to be able to do is say, you know, employee A worked on project 1, 2, 3, 4, 5, and break down the amount of time that they worked. If you have time tracking, that's great. If you
Yeah.
don't have time tracking, you can use estimates of, you know, as long as you're showing the nexus between what the qualified project is and the qualified employees, applying those percentages, and then you apply those percentages to their W-2 wages. And that's
Okay.
how you figure out what drops into the qualified bucket.
Okay, and that can be done, as you said, 3 years back as well.
Yep. You do have to amend the prior year returns
Yes.
in order to claim prior year credits, but absolutely, you can go back 3. You can go back to 3 years unless your company is a C Corp and you've been generating losses, you possibly can go back farther than that.
Yeah, we're a C Corp, but luckily we're not generating losses anymore.
Okay,
So
yeah.
you can see it both ways, right?
It's a good answer. It's a good answer.
We can't
Yeah.
save anymore, but or not more. But maybe it's well worth looking into that for the year
And if
back.
you know,
I mean,
more,
that's good. Thank
If
you
we
for
can
the
help-
advice. Yeah.
Of course, yeah, absolutely. If we can help in
And-
any way, I mean, and you know, I'd be happy to, you know, take it offline and discuss with you, but you know, help you figure out how to get it with your CPA as well. However,
that
you
would be
wanna do
good.
it.
Yeah, thank
Okay.
you. Thanks.
Thank you. Any other questions?
Yeah, let me ask you a quick one. So we filed R&D taxes first time probably about 6-7 years ago, and then we
Right.
amended 3 years as well. So interestingly, next year we were hit by an audit. So my question, I know there is no good answer to this question, but my
Right.
question is it kind of statistics that we were just unlucky, or filing R&D tax will increase the probability of audit?
I'm going to say, Alexi, that it depends on how much the credit you were claiming was. So if your credits were in the millions of dollars, then I'm going to say they probably pulled you because it's R&D. If your credits are in the, you know, like low hundreds, 100,000, you know, 50,000, 100,000, it's probably just luck of the draw. It's typically not something that they're going to come look at you for, you know, in that lower range. But I can tell you for sure, like if your credit's $1 million, probably the vast majority of those, if not all of them, are going to get looked at. Very large credit numbers are going to get pulled. Does that answer your question?
Yeah, absolutely.
I often like to describe an R&D tax credit like on when you prepare your own individual return and on your itemized deductions. So let's say you have a mortgage on your home. Your financial institution will send you a sheet of paper that says you paid this much mortgage interest for the year. You take that number, you report it on your return, no question, right? Then you get your receipt from maybe Goodwill Industries in which you donated 5 bags of clothing, right? Well, so then you might say, well, those 5 bags of clothing were all worth $100. Well, I might say they were all worth $200. Somebody else might say that they're worth $1,000, right? Is that there's all that justification there as to how you would say what the value of that is. That's an R&D credit, is that it's not exact or precise. There's an art to it. And a justification. And so that's why the IRS is like, if they're substantial, they might say, let's take a look at them. But I would say they can be substantial because you have substantial R&D, right? It's just that the IRS might want to take a look at it because there's some play with it.
Right. Yeah, I mean, essentially, that's what they were trying to understand. I mean, if we basically assign part of the wages, assign them to R&D activities, so essentially, what do we consider as qualified R&D activities? And I think that's the main question anyway, because it's kind of a gray zone, and clearly, there are some. What you've shown, there are some identifications that help you to figure it out. But as many things in the tax code, I mean, you still have some room for interpretation, right?
Exactly. And the important thing is building the support for what were your qualified activities and how did you get to those numbers?
Right.
Exactly.
And so not on a sales side, but this is a sales side, is that CLA probably has more than 20 professionals throughout the country that all they deal with is research and development tax credit, but they also study all what the case law has been on an annual basis associated with the R&D and what is Internal Revenue Services. What are they looking at? What are the issues? What are the different things? So as we go to market and prepare our research and development tax credit studies, we're already aware of, the ebbs and flows of the IRS and what issues that they're looking at on those. So we would never suggest going at it alone. All right, given that, and to move forward a little bit, too, is that, thank you, Jenny. One thing, Jenny, that we didn't cover here is that the work opportunity tax credit. If you want to talk just a little bit about that, just because this is probably a veterans area.
Absolutely, absolutely. Yep. So the work opportunity tax credit is totally different than R&D. This is a hiring credit, and you can get it's basically an onboarding credit, right? When you hire somebody, so you can get up to $2,400 per qualified person. Actually, if you were to hire an unemployed disabled veteran, that's probably the best credit that you can get. So it's something that you look at in the onboarding process, and it's something that we have that as a service. Some of your payroll companies are going to have it as a service, where you have to do screening for employees as they're really intending for you to discriminate in favor of hiring employees from certain pools. It can be employees that are coming off of unemployment or temporary assistance for needy families. There are a bunch of categories that are around that. It also can be certain employees that just happen to live in a certain zip code, and you get a credit for them. So what you would want to have in place is a screening tool. So when you're hiring somebody, they would just fill out some forms for you, and right when you're onboarding an employee, they're willing to fill out all the forms. If you get a hit, based on what they've filled out in their onboarding forms, then we would ask them. So for example, if they were coming off of unemployment, the company, the provider then has to go follow up with that state's Department of Unemployment or Reemployment in the case of Florida, and get a confirmation that they are a qualified applicant, and then you get the credit, and that goes against your income tax. Any questions about that?
My understanding of that tax credit is there's basically an allotted budget every year for it, and it's first come first serve who gets that based off of when they file for the credit. Is that because the money could go away during the year? Is that accurate? Or?
I don't think so, Baron.
Okay.
With the work opportunity tax credit. Now, if it's a state level thing, I could see that. So if there was a Florida amount associated, I would agree with you. I don't think with work opportunity tax credit, I'm pretty sure that's you get what you get. What you calculate is what you get.
It used to be that way for the Florida Research and Development Tax Credit. This WOTC is actually a federal tax credit there. And so for right now that's not the case. It's still, I don't think it's a permanent credit that's out there, but you can get as much of a credit for hiring a veteran up to $9,000 just for hiring a veteran. And so it's good to at least have the understanding of it. At least, if you're looking at two candidates and they're both the same and you're not sure which one to hire and one's a veteran, you know what I'm saying? It might be a no-brainer to you to bring that on. And so just to have some awareness about it. But if there was anything more, you are just know that there is awareness out there and we can help you.
But you do only have 28 days from the time that person is hired.
You can't just go, oh man, I just hired 3 veterans last year. It's very, very timely there to have awareness of it. So we're going to keep moving on. Thank you guys so much. Is that Sylvia, if you want to talk a little bit more about more on the global piece of it, that would be great.
Okay. So I will just talk very quickly, so Marnie can talk.
That's right.
On time. Okay, so I just sort of want to touch base. I know we're talking about tax saving, but the tax saving here is probably just be aware of the different disclosures related to any sort of inbound and outbound activity, just because the US require a lot of disclosure and there's significant penalty usually related to not disclosing some of those activities. So that will be your savings, I think. So inbound, outbound. And I've listed a couple of topics. Those are just sort of what I have seen a lot more lately related to my clients and the inquiries that they have. So because of COVID, employees maybe, you know, go visiting their home country, going back to home country, working virtually, or actually coming to the US and hang out with their family while they're working. So this may have created just some exposures for the companies that they're not really aware of. So usually the HR find out maybe months later that they have an employee for the company and have been working outside of the US this entire time. So just sort of understand what that exposure might be. Revenue sourcing. So if there's just a lot of increased US disclosure requirements. So we talked earlier about flow-through entities. So for partnerships and S corporations, you now have to disclose whether you have foreign source income, where they're all coming from, because you're issuing K1s to the different shareholders or partners of the entity. So that's required. For C corporation, if you have foreign related parties, if you have transactions, you purchasing products, you have sales, you have loans between each other, those are required to be disclosed, and there's severe penalty for not disclosing those information on your annual tax return. And companies are looking into new supply chains because of recent events. So maybe they're looking into new jurisdictions that they want to do business with, and understanding the local laws, understanding how to do business in the new jurisdiction. Involves with that is structure planning. What's the most tax efficient way to set up your structure and do it right from the beginning, instead of dealing with the trouble later at the end, discovering something that wasn't set up correctly. Most of my clients that are foreign owned, they actually strive during the period of COVID. So a lot of them is actually profitable, or their profit actually increased during this period. So then transfer pricing become a little bit more important when all of the countries are looking to generate revenue, whether your profit margins within the reasonable range. Are you shifting your revenue? Are you shifting your income in a lower tax jurisdiction? Also with the talk of the minimum tax across the countries and how that will be implemented here shortly. Then also when we're talking about different jurisdictions, a lot of time they don't really need US audit because they're not really funded by local US bankers. So they're funded by the parent entities. So if they don't need US GAAP audit, sometimes they would need IFRS or some sort of packaging and review of the financial, just so they can be in compliance with the parent group's activity the financials will drive. So yeah, so those are just some of the topics I want to touch base. And then if anybody has any questions, or I'll pass on to Marnie.
Yeah, I have actually a quick one about that. So if I understand correctly, so if you have an employee, so locally hired with, basically all the, accordingly paperwork for US hire, but this person spends, let's say, 4 months outside of the country. So it doesn't make them any different than local employees, or it does?
So generally 4 months, it's okay. So usually when the US look at it, they're looking at 183 days, so it's 6 months. So once your employees step outside the country in 6 months, is sort of created. So Tom earlier was talking about states within the United States, there's different nexus. So when you step out of the country, then that foreign jurisdiction, that just say this employee goes to UK and stay in the UK for 6 months. So now the UK tax authority may say, hey, wait a second, you're a very profitable US company. You have an employee now, it's located here in the UK, you're sort of benefiting from our country. So what this employee is actually doing is creating a physical presence then for the company in UK, and whatever that exposure might create for the company. So yeah, those are sort of what happened
you.
when the employee go overseas. Okay.
Personally, that all seems like a nightmare to me. And so we'll just see where that all goes as far as, with our virtual world and everybody working from home, but what is home now? And so, is home a mobile home where you're, working virtually from various state parks throughout the country? And so, I think those are, I'm anxious to see, in the next couple of years, really what, comes of that. Let me run real quickly through some of this taxation, and then we're going to answer this question that Mike had for the state and local tax, because it kind of fits into some of the state and local tax here. These are some things that we're seeing for on the 2021 returns that we're preparing. Some of this is old news. Some of you might already be aware of it. Some might not. I will say that when the Tax Cut and Jobs Act was passed under the Trump era, that was the first time that there was really tax reform since the Reagan era. And so as CPAs, we were super welcomed it, because we just really saw that there were some definite needs on tax legislation. So we were really happy. We learned a new tax act and how we could implement it, advise our clients and things like that. And then all of a sudden COVID hit, and we had all these other tax acts hit just immediately. And then, running them on the fly then too, as to what they meant, with their clarification. And then there's still not some clarification in some of these tax acts. And so that's been just a big heartburn for us. I think we're finally trying to get through some of that and understanding what some of that, what that ultimately looks at. Sylvia, go to the next slide. The PPP loans, if you did get any of those, I think everybody realized that the income piece of it, when you're forgiven of debt, that's really income. And so but that income is excluded from taxation. The nice thing is that Congress came forward and said, well, but also we're going to let you deduct those expenses that were related to you getting that PPP loan. And so we navigated that. Took for a long time is for us to even understand if those were going to be deducted or not. And so we're working through now what those PPP loan forgiveness looks like. If you go to the next slide, please, is that a lot of people know about the PPP loans, is that here is the employee retention credit. And so this employee retention credit is actually a payroll tax credit. You could get the employee retention credit for 2020 and also for 2021. So this employee retention credit is absolutely huge. So if you're not aware of it, is that it's super important that you could even follow up, and we could give you a guideline to see if you fit into this or not. So very quickly for 2020, it's a payroll tax credit. It's not a payroll on your income tax. It's payroll for your, it affects your payroll tax returns. It affects your income tax returns because the expenses, the wages that were used to get this credit, then it cannot be deducted on your income tax return. So it's a comparison of quarterly top line revenue, gross revenue from quarterly from 2020, also 2021, back to 2019. And so at any time of those quarters in 2020, if that top line revenue was less than 50% of that same quarter in 2019, you are eligible for this employee retention credit in 2020. That credit could be up to $5,000 per employee. So if you had 5 employees, you could have received a $25,000 credit in 2020. You had to get over that threshold of the 50%. They rolled it into 2021. They took away the 50% threshold and just said, if you had a gross revenue comparison, you can keep moving on, Sylvia, and go to 2021, is that if you had a gross revenue comparison of 2021 quarterly revenue to 2019 and you were less than 20%, then you are eligible for this employee retention credit in 2021. But they gave you a $7,000 per quarter per employee. So let's say you go back to those 5 employees, then every quarter you could get up to $35,000 per quarter in 2021. So now you're looking at close to, what is that, 105,000, right? I think as if I can't do any math in my head. So, but I'm thinking that was the right math. And so it's a huge credit, a huge credit. So if you haven't heard about it, then we're more than happy. We have a little guide and it was fit right into our marketplace of our clients. And so we really understood this credit a lot. And so what that might look like. The biggest thing here is that you can't double dip. So these employee retention credits also played into some of those wages then that were used for the PPP loan forgiveness. They also fit into those wages then for what Jenny talked about, the research and development tax credit. They can fit into some of those wages that were also used for the work opportunity tax credit. So we had a whole Excel spreadsheet that runs the benefit of the efficiencies of these credits. Obviously, the PPP loan is the best way, but then we go to this employee retention credit, which is a great credit. And then if you have left, then we look at the R&D credit or this work opportunity tax credit. So we've got some clients that are just getting some substantial credits on this employee retention credit. They're still getting their research and development tax credits. And they got total PPP loan forgiveness. You just have to really, really watch that play in there. So again, if you don't know about the employee retention credit, please reach back out to us. The next thing that we also saw is that deductions for restaurant meals. So in the year 2021 and 2022, you can take 100% deduction for restaurant meals. So whereas before, meals were typically subject to the 50% disallowance. Like if you had, a spend of $1,000 in meals for the year, you could only deduct $500. Now, if you could prove that these meals were actually for restaurant meals and that they weren't like, Publix, grocery store Publix subs, is that you can deduct 100% of those restaurant meals for 2021 and 2022. The next thing that went into for individual tax, the bigger things that flowed into individual tax is that there's a ton itemized deductions with the Tax and CARES Act in 2017. Then the itemized deductions amount went really, really high. So then for standard deductions. So some people weren't itemizing anymore, and the not-for-profit organizations were like, oh my gosh, nobody's going to contribute to charity whatsoever. And so Congress came in and said, you know what, we're going to give you a charitable deduction on your return of $600 for married filing joint and $300 just for individual returns there. Then the next slide that you saw is that there's a ton of refundable credits on our 2021 returns. I just completed my daughter's return. She just started she graduated college and started working at a job. And so she's contributing to the 401k. And since her income is lower, she got a credit for contributing to the 401k. There's just a ton of refundable credits. A lot of times a tax credit is only a credit against actual tax liability that you have. But if a tax credit is calculated and you don't really have any tax liability, you can get the entire amount refunded. And so we're seeing a lot of those benefits are still coming out because of this COVID legislation. There's child tax credits out there. People were getting advance payments on child tax credits, and IRS is issuing a letter to say, this is how much you got in these advance payments. The only thing is that if you phased out of this and you had a good year in 2021, you actually might have to pay this child tax credit back. And so that's probably the only harm that I've seen in anything so far, is that otherwise, there's still, the government is still doling out a lot of free money. Sorry, I just had to get a little bit of my personal view in there. So we'll just keep moving for a second. And so what else? I think maybe I have another slide in there, Sylvia, or I'm not sure.
Recovery.
Oh yeah, so the last stimulus check was given in March of 2021. It was $1,400 for the taxpayer, spouse, and even qualifying dependents. And so maybe somebody had a good year in 2020, they can get this refund then through their tax return for March of, and on their 2021 return. And so this is something where my daughter was a dependent in 2020. She graduated college mid-year. She started her own job. She's on her own, and so she actually qualified for this $1,400 stimulus check, and so she'll get it through her refund of her return there. So those are some of the things that we're still seeing on those individual returns. I know it's 10 minutes after. We're still gonna, if anybody else had a question, but Mike had a question. Tom, I'll read it to you. I have clients in Florida, New York, Connecticut, Louisiana, California, Texas, Alabama, potentially Nevada. There will soon be a few other clients. My understanding is that I am not subject to state taxes, as his operations, because he's an investment advisor, are primarily in Florida. Is that the case?
Right, and as is with every state tax, answer is it depends, right, Mike? And so it depends on the tax you're talking about. It depends on what you're doing in these states. So for example, if we're talking professional services and we're talking, all right, from a sales tax perspective, likely you're fine, right? States don't generally tax professional services from a sales tax perspective. From an income tax, it will depend. It depends on, are you going to visit these clients at all? Does that state have what we were talking about before, an economic nexus standard for income tax? Does it even have an income tax? Is it a gross receipts tax? And then also to that point, if we're talking income tax, right, and without getting into too much detail because we're 10 minutes over here, it depends on, hey, if I'm performing all my services in Florida, even if, let's say, Nevada or whatever state, can tax my income, how do they get that, right? How do they get that portion of income? They generally look at your federal taxable income and try to apportion it based on revenue in their state to total revenue. And by providing a service, you say, well, if I provide a service for someone in a different state, is it deemed a state sale there because that's where my client is, or is it a Florida state because that is where I'm providing a service? And that's going to depend on the state as well. So it depends is the answer.
Thanks.
I have one quick, Marnie, you mentioned about this restaurant credit that it can be deducted 100%.
Yeah.
So one thing that I'm confused about, so you can deduct restaurant 100%, but it's not going to be entertainment. So what else do you do in a restaurant besides entertainment? So what will qualify, what not? Let's say company party does not qualify for that, right? So, but if I take a group of 10 people to lunch, so then it does qualify. Or is there some kind of a, line in between that?
Yeah, so the entertainment piece would be more so like if you took me to the Orlando Magic basketball game, if you wanted to at any time. I'm just suggesting it. It's that's not deductible. But let's say that we stopped, on the front and we had a meal at a restaurant. That's 100% deductible there. So that's your distinguishment between meals and entertainment. Did I answer your question?
So company party of 50 people, if it meals only, no music, no dancing, does it qualify as an entertainment or not?
Well, that qualifies.
No, it's a serious
super
question
boring.
because that's what we're dealing with all the time, right? So you go there, you have some kind of a party, and then you invite everyone, and then becomes a question. Well, is it entertainment or it's kind of a business lunch, dinner, whatever, right?
Aren't we deducting company parties?
100%.
Yeah, I would deduct your company party 100% because it's an employee. It's if you're not inviting anybody else to it and it's just
Right.
in an internal piece of it, then that's
Mhm.
100%.
Oh,
to
okay, okay. That makes sense, yeah. Okay, well, great.
Great. Yeah. Hey, Marnie, Sylvia, Jenny,
Yeah.
Tom, I thank you for your time this afternoon. A lot of great information. My primary takeaway is anybody who's in business, either, kind of individuals, sole proprietor, or running a business with employees, you're crazy to go about any of this on your own. Reach out to an expert. There's so many things that are changing every year. Utilize the resource and expert like CLA to help make sure you're not missing anything, whether you're failing to pay something or failing to get savings on something you should get it on. So thank you
Yeah.
again for your time today. Really appreciate it. And look forward to
No,
working with you in the future.
I would just say this is that if you're working with a smaller CPA, we are more than happy, like for Jenny, just to come in and do the research and development tax credit. Is that we're more than happy to team with the CPA that you're working on to help with that. And so the international piece or state and local, like that's not a big deal for us. We often do that. So just FYI. Thank you so much, you guys. We really appreciate this opportunity, and I just appreciate my team in this busy time to take some time out of your day to give the presentation and put the slides together and prepare for it. So
Absolutely.
Yeah,
Well,
thank
thank
you
you.
so much.
And hope everybody has a
you.
great
Thank you for the
afternoon.
information and your time. Thank you.
Thank
Bye.
you.
Thank